Self-employment tax is the tax that punches every freelancer in the gut the first time they see it. The IRS Self-Employment Contributions Act applies a 15.3% rate on net earnings, on top of regular income tax. That is 12.4% for Social Security and 2.9% for Medicare. Today, what it actually means and how to plan around it. Quick history. When you work for an employer in the U.S., your pay stub shows a 7.65% FICA deduction. The employer pays a matching 7.65% that you never see. When you go self-employed, you become both employee and employer, so you pay both halves. That is where 15.3 comes from. The base for 2026. The Social Security wage base, set annually by the Social Security Administration, is $178,000 for 2026. So 12.4% applies only on net earnings up to that ceiling. Above it, you still pay the 2.9% Medicare portion, plus an additional 0.9% on earnings above $200,000 single, $250,000 married. Here is the calculation that actually matters. Your gross revenue minus your business expenses equals net profit on Schedule C. Multiply that by 92.35% to get net earnings from self-employment. Then apply 15.3% up to the wage base. The IRS lets you deduct half of the SA tax against income tax via Schedule 1, an above-the-line deduction. A worked example. Sarah, a freelance designer in Austin, has gross revenue of $70,000 and business expenses of $15,000. Her net profit is $55,000. Times 92.35% equals $50,793. Times 15.3% equals $7,771 in self-employment tax alone, before any income tax. Now the income tax layer. Sarah deducts half her SA tax, $3,886, plus she takes the standard deduction of $15,000 for 2026. Her taxable income drops to roughly $36,000. At single filer rates, that puts her in the 12% bracket with a few $100s at the 22% edge. Federal income tax adds about $3,900. Total federal tax bite for Sarah, $11,600 on $55,000 of profit, roughly 21% effective. Add state tax on top, which varies. Texas has zero state income tax. California would add another $3,000 or so. The Tax Foundation publishes a state-by-state effective rate map updated annually that walks through this. The Estimated Payments Rule. The IRS expects you to pay tax as you earn it, not in a lump sum next April. Form 1040-ES handles 4 quarterly payments. Miss them and the underpayment penalty hits, currently around 8% annualized per the Federal Reserve update of October 2025. The dates are April 15th, June 15th, September 15th, and January 15th. Safe Harbor Rule. The IRS lets you avoid the underpayment penalty if you pay either 90% of current year tax or 100% of last year's tax, 110% if your prior year AGI was over $150,000. Most freelancers use the prior year method because it is predictable. Just take last year's tax bill, divide by 4, and pay it. Critical move, separate accounts, and a tax holding bucket. Open a separate business checking and a savings account labeled tax. Every time a client invoice gets paid, transfer 25 to 30% into the tax bucket. When quarterly payments hit, the money is already there. The Federal Trade Commission has flagged commingling as one of the top 3 reasons small businesses lose deduction documentation in audits. S-Corporation election, a real money saver above a threshold. If your net profit consistently runs above $70,000 or $80,000 a year, electing S-Corp status with Form 2553 lets you split income between salary and distributions. The salary portion is subject to FICA, distributions are not. Done correctly per IRS guidance, this can save $5,000 to $10,000 a year in SA tax. The catch with S-Corp. The IRS requires reasonable compensation for the work the owner actually does. Pay yourself too little salary and an audit will reclassify distributions back to salary, with penalties. Reasonable compensation studies from RC reports show market rates for various professions. A solo software developer might justify $60,000 salary on a $120,000 profit, paying a tax only on that $60,000. Cost of the S-Corp setup is $200 to $300 in state filing fees. Annual costs include payroll service like Gusto or OnPay at around $500 a year, plus a CPA for the corporate tax return at $800 to $1,500. So total annual overhead runs about $1,500 to $2,000. Below $70,000 profit, the math usually does not work. Retirement accounts that reduce SA tax base. Solo 401k contributions made as employer profit sharing reduce the net earnings calculation for Southeast tax purposes. The 2026 limits per IRS Notice 2025 to 67 are $70,000 for the combined employee plus employer contributions. SAPIRA contributions also reduce SA tax base when structured correctly. UK readers, the national insurance equivalent. Self-employed Class 2 contributions were merged into Class 4 starting from 2024. Class 4 is 6% on profits between £12,570 and £50,270, then 2% above that. Plus regular income tax on top. HMRC's online self-assessment portal calculates everything together once you enter the figures. The voluntary contributions trap and benefit. Class 2 NI used to be how self-employed people earned credits toward the state pension. After the merger, low-earning self-employed who fall below the small profits threshold can pay voluntary Class 2 to keep building state pension entitlement. At £3.45 a week, it is dramatically cheaper than Class 3 voluntary contributions and worth knowing if you have lean years. Quarterly prepay strategy. Most freelancers wait until each quarterly deadline to fund the payment. A better move is treating the tax bucket as money that does not exist. Transfer the percentage immediately on every payment received. Treat the tax account like the IRS already owns it, because functionally, they do. This single behavioral shift fixes the cash flow surprise that catches new freelancers in year one. The real underrated move: hiring your kids if you have them. If your kid is under 18 and you operate as a sole prop or single member LLC, wages paid to them are not subject to FICA per IRC Section 3121(b)(3). The first $15,000 for 2026 matches the standard deduction, so the kid pays zero income tax too. Just need real work and real records. What real work qualifies for kids? Filing, basic bookkeeping, social media content creation, photography for the business, packing orders if you sell physical products. The IRS rejects fake jobs immediately, so keep timesheets, written job descriptions, and a clear pay rate that matches market rates for the actual work. Done right, this strategy moves taxable income to a zero-bracket family member legally. QBI deduction is still in play, even with SE tax. The qualified business income deduction under IRC Section 199 reduces income tax but does not reduce SA tax. So a freelancer at $55,000 profit gets the QBI deduction stacked on top of SA tax obligations. Keep them separate in your mental model, otherwise the math gets confusing fast. When to actually pay a CPA? If your profit is under $30,000, free filing through the IRS Free File program covers most of what you need. Above that, a CPA who specializes in freelancers usually saves 2 to 5 times their fee through deduction optimization and entity structure. The National Association of Tax Professionals directory lets you search by specialty and zip code. The audit reality for freelancers. Per the IRS Data Book 2023, Schedule C filers earning under $100,000 had an audit rate of about 0.5%. Above $200,000, the rate climbs to about 1.7%. The biggest red flag is reporting net losses 3 years running, which the IRS uses to challenge whether the activity is a legitimate business or a hobby per Section 183. Last big move: contribute to a Roth IRA in low-income years. If your taxable income is low because you are reinvesting in your business or you had a slow year, a Roth IRA contribution lets you lock in tax-free growth at a low rate. The 2026 limit is $7,000, $8,000 if you are over 50. The income phase-out starts at $150,000 single. Subscribe to Finanzas Clara and hit the bell. What's coming next week? A deep dive on the S-Corp's salary calculation that an IRS auditor walked one Reddit user through, including the exact reasonable compensation worksheet they used. Drop a comment with your toughest self-employment tax question and I will tackle the top 3 in a follow-up.